Hello everyone and welcome to Finance for Engineer course. Till last session, we had discussion on basics concerning to financial statements, that is, its meaning and significance. Then, the types of financial statements prepared by the business organizations. Then, we discussed various tools and techniques that are used to analyze the financial health of the business firm. For example, comparative statements, common size statements, trend analysis, and finally, ratio analysis. By applying these techniques, one can easily evaluate the financial performance and financial position of the business firm, and one can take important decisions related to investment or any other issues. Today, we are about to start third unit, the management of working capital. There are two types of assets in each concern, that is, fixed assets and current assets. Both types of assets are to be managed efficiently so as to earn maximum profit with minimum possible investments, because maximization of profit is the prime objective of every business. Decisions regarding investment in fixed assets are taken through the capital budgeting process, but decision making regarding management of working capital is a continuous process which involves control every day the flow of financial resources circulating in the enterprise in one form or the other. The accomplishment of the prime objective, that is, maximization of profits in most businesses, depends largely how their working capital is managed. Working capital management is considered to involve the management of current assets, that is, cash, accounts receivable, and inventory. There are certain special problems peculiar to the management of working capital requiring operational and financial skills of a high order. So let us see what is working capital. Every running business needs working capital. Even a business which is fully equipped with all types of fixed assets required is bound to collapse without adequate supply of raw materials for processing, cash to pay for wages, power, and other costs, creating a stock of finished goods to feed the market demand regularly, and the ability to grant credit to its customers. All these require working capital. Working capital is thus like the lifeblood of a business. The business will not be able to carry on day to day activities without the availability of adequate working capital. The management of working capital or current assets is as important, or rather more important, than the management of fixed assets, because the fate of most of the businesses very largely depends upon the manner in which their working capital is managed. Thus, uses of funds of a concern can be divided into two parts, namely long term funds and short term funds. The long term investment may be termed as fixed investment. A major part of the long term funds is invested in the fixed assets. These fixed assets are retained in the business to earn profits during the life of the fixed assets. To run the business operations, short term assets are also required. Thus, the term working capital is commonly used for the capital required for day to day activities of the business concern, such as payment to creditors, salary paid to workers, purchase of raw material, etc. Normally, it consists of recurring in nature. It is calculated as the current assets minus the current liabilities. It can be easily converted into cash. Hence, it is also known as short term capital. Thus, we can see that working capital is nothing but the circulating capital required to meet the day to day operations of a business firm. It consists broadly of that portion of assets of a business which are used in or related to its current operations. It refers to funds which are used during an accounting period to generate a current income of a type which is consistent with major purpose of a firm classification of working capital. Here you can see working capital is classified into two categories. First is value based working capital and another is time based working capital. Value based working capital is further divided into two: gross working capital and net working capital, while time based working capital has got divided into two: temporary working capital and permanent working capital. Value based or conceptual based working capital. First is gross working capital. It also refers to the firm's total investment in current assets. The current assets that are employed in business gives us an idea about the utilization of working capital and about the economic position of the company. Second is net working capital. It means current assets minus current liabilities. That is, the difference between current assets and current liabilities is called as net working capital. If the net working capital is positive, then it can be said that the business is able to meet its current liabilities. Net working capital concept provides the measurement for determining the credit worthiness of the company. Next is time based working capital. It is permanent working capital. This type of working capital is known as fixed working capital. Permanent working capital means the part of working capital which is permanently locked up in the current assets to carry out the business smoothly. That is, the minimum amount of current asset which is required to conduct the business smoothly during the year is called as permanent working capital. Permanent working capital is permanently needed for the business and therefore it should be financed out of long term funds. In other words, it represents the current assets required on a continuing basis over the entire year. The amount permanent working capital grows with the size of the business. In other words, we can see that greater the size of business, greater is the amount of such working capital and vice versa. For example, investments required to maintain the minimum stock of raw materials change with the size of the business firm. Next is temporary or variable working capital. The term variable working capital refers that the level of working capital is temporary and fluctuating. It represents the additional current assets required at different times during the operating year to meet additional inventory, extra cash, etc. In this case, the amount of such working capital keeps on fluctuating from time to time on the basis of various business activities. In other words, it represents additional current assets required at different times during the operating year. For example, extra inventory has to be maintained to support sales during peak sales period. Similarly, receivable also increase and must be financed during period of high sales. On the other hand, investment in inventories, receivables, etc. will decrease in period of depression. Suppliers of temporary working capital can expect its return during off season when it is not required by the firm. Hence, temporary working capital is generally financed from short term sources of finance such as bank credit. Variable working capital may change from one asset to another and changes with the increase or decrease in the volume of business. So it can be said that it is nothing but the difference between net working capital and permanent working capital. A stable business should have smaller fluctuations, and a bigger and growing business would have bigger fluctuations. Therefore, temporary working capital is also called as fluctuating working capital. Now, the next is graph. Here you can see the graph showing working capital of a growing firm. Here it is clearly visible that permanent working capital is increasing consistently as per the increase in the volume of the business, while temporary working capital show fluctuating trend during a given period. See, students, there is a prime reason behind differentiating permanent working capital and temporary working capital. It is the decision actually relating to the financing mix of the working capital gap. Normally, temporary working capital is financed by short term financing sources. Short term finances have always time flexibility. We can use them and repay them when our purpose is served. For example, a cash credit limit that is extended by the bank is a common way of addressing the temporary working capital. You pay interest on the amount used for the period of use only. Therefore, in such a situation, idle cash is also utilized to pay off the outstanding short term finances and save on interest costs. Now, the next is components of working capital. First is current asset. These assets are generally realized within a short period of time, that is, within 1 year. And current assets include inventories or stocks that can be of raw material, work in progress, consumable stores, and finished goods. Next is sundry debtors, bills receivables, prepayment, that is payment made in advance, short-term investment, accrued income, and cash and bank balances. Next component of working capital is current liabilities. Current liabilities are those which are generally paid in the ordinary course of business within a short period of time, that is 1 year, and it include sundry creditors, bills payable, accrued expenses, bank overdrafts, bank loans, that is on short term, proposed dividends, short term loans taken from financial institutions, etc., and tax payments due. So these are various components of working capital. The next is operating cycle. Operating cycle is a time duration required to convert sales after the conversion of resources into inventories into cash. So this operating cycle of manufacturing company, which involves three different phases. First phase is acquisition of resources which are required for manufacturing a product such as raw material, labor, power, and fuel, etc. Then the second phase is actual manufacturing process of the product, which includes conversion of raw material into work in progress and then producing finished product. And the third phase is sale of product. It can be either on a cash basis or credit. Credit sales create account receivables for collection. So these are the three important phases normally of a manufacturing company. So let us see how it works. So working capital is also called as circulating capital or revolving capital. That is the money or capital which circulates in various forms of current assets in a continued manner. For example, at a point of time, cash may be tied up in raw material, then latter converted into semi finished products, then into finished or final product, and when these finished products are sold, it is converted either into receivables or cash. This cash is reinvested in current assets, thus, the amount always keeps on circulating or revolving from cash to current asset and back again to cash. That is why some people prefer to use the term liquidity management instead of working capital management. Although this circulation takes place at short intervals, the money is required again and again. The working capital cycle for a business is the length of time it takes to convert the total net working capital into cash. Businesses typically try to manage this cycle by selling inventory quickly, collecting revenue from customers quickly, and paying bills slowly to optimize cash flow. So, next point is significance of operating cycle. Partners, why is operating cycle important? The operating cycle is important because it can tell a business owner how quickly the company is able to sell inventory. It determines the company's efficiency. For example, if its operating cycle is short, this means the company was able to make a turnaround relatively quickly. It could also mean it has shorter payment terms and strict credit policy. A shorter operating cycle is more favorable as it means the company has enough cash to maintain operations, recover investments, and meet various obligations. In contrast, if a business has a longer operating cycle, it means the company requires more cash to maintain operations and it can create cash flow problems. Just as there are many influences on a company's operating cycle, there are also many ways that an operating cycle can help determine a company's financial standing. The better a business owner understands the company's operating cycle, the better that owner will be able to make decisions for the benefit of the business. A company can reduce its operating cycle in two ways. That is, first, by speeding up the sales of its inventory. If a company is able to quickly sell its inventory, the operating cycle can decrease. Second, by reducing the time needed to collect receivables. If company is able to quickly collect credit sales more quickly, here also it is possible to decrease the operating cycle period. Now the next point is how to determine the operating cycle. In order to determine a company's efficiency, business owner needs to calculate their operating cycle. He needs to follow the following steps for calculating operating cycle. First is determining the inventory period. First, business owner needs to identify or calculate company's inventory period for calculating operating cycle because it is one of the important component of the formula. Next, inventory period refers to how long a company holds its inventory before it's sold. The inventory period can be calculated as follows. Inventory period is equal to 365 divided by inventory turnover. This ratio we have already studied in a ratio analysis under the head activity ratios. To determine a company's inventory turnover, we need to divide the cost of goods sold by the average inventory. The average inventory refers to the average of the company's opening and closing inventory. This can be found on the company's balance sheet, whereas the cost of goods sold can be found on the company's income statement. Second step is to determine the company's account receivables. Business owners also need to know their account receivables in their operating cycle calculation. It refers to the amount of money a customer owes a company. Account receivable can be calculated as follows. Account receivable period is equal to 365 divided by receivables turnover. To determine a company's receivable turnover, divide credit sales by the average account receivable. Then we need to determine the company's account payable. Business owner again need to identify the amount of account payable. Account payable refers to the amount of money a company owes a supplier, and it can be calculated by using following formula. Account payable period is equal to 365 divided by payables turnover. And to determine company's payable turnover, need to divide credit purchases by the average accounts payable. Then one can calculate operating cycle by using following formula. Operating cycle, which is also called as cash conversion cycle, is equal to inventory period plus account receivable period minus accounts payable period. The resulting number is the number of days in the company's operating cycle. You can see here an example given. Inventory days 85, receivables days 20, payable days 90. Now, working capital cycle or operating cycle is equal to 85 plus 20 minus 90 will give 15 days. This means that the company is only out of pocket cash for 15 days before receiving full payment. So, by this way, one can calculate the operating cycle of any business organization. Now, the next slide is concerned with importance of working capital. Working capital is just like the heart of business. If it becomes weak, the businesses can hardly prosper and survive. It is an index of the solvency of a concern. Its proper circulation provides to the business the right amount of cash to maintain regular flow of its operations. The following are few advantages of adequate working capital funds in business. First is cash discount. If proper cash balance is maintained, the business can avail of the cash discounts facilities offered to it by the suppliers. Second, liquidity and solvency. The proper administration of working capital enhances the liquidity in funds, solvency, and creditworthiness of the concern. Next is meeting contingencies. It provides funds for unforeseen emergencies so that a business can successfully sail through the periods of crisis. Next is high morale. The provision of adequate working capital improves the morale of the executives and their efficiency leads it to higher peak. Next is good bank relations. Good relations with banks can also be maintained. The enterprise, by maintaining an adequate amount of working capital, is able to maintain a sound bank credit, trade credit, and can escape insolvency. Next is fixed assets productivity is increased. Fixed assets of the firm cannot work without proper amount of working capital. Without it, fixed assets are like guns which cannot shoot as there are no cartridge. Next is research and innovation. No research, innovation, and technical developments are possible to be undertaken without sufficient amount of working capital. Expansion facilitated. The expansion of a firm is highly successful if it is financed through own working capital. Next is profitability increased. The profitability of a concern also depends on the right proportion of fixed assets and current assets. Every activity of the business directly or indirectly affect the current position of the enterprise. Hence, its need should be properly estimated and calculated. Thus, the need for maintaining an adequate working capital can hardly be questioned. Just as circulation of blood is necessary in our human body to maintain life, smooth flow of funds is very necessary to maintain the health of the enterprise. Thus, the importance of working capital can be very well explained in the words of husband and Dockery. The prime object of management is to make a profit whether or not this is accomplished in most businesses depends largely on the manner in which the working capital is administered. Now let us see factors affecting on working capital. The working capital requirements of a concern depends upon a large number of factors such as nature and size of business, the length of production, next is seasonal variations, credit policies, etc. It is not possible to rank them because all such factors of different importance and the influence of individual factors change from firm over time. However, the following are important factors generally influencing the working capital requirement. The first is nature of business. The requirement of working capital also varies among the enterprises depending upon the nature of business. See, in case of trading concern or retail shop, The requirement of working capital is less because length of operating cycle is small. While in case of wholesaler, when we compare with a retail shop, requirement of working capital is more. Why? Because they have to maintain large stock and generally sell goods on credit, which increases the length of operating cycle. The manufacturing company requires huge amount of working capital because they have to convert raw material into finished goods. They also sell on credit, required to maintain inventory of raw material as well as finished goods. So thus it changes from organization to organization or business to business. Second point is scale of operation. The working capital requirement of a concern is directly influenced by the size of its business, which may be measured in terms of scale of operations. The firms operating at large scale need to maintain more inventory, debtors, etc. So, they generally require large working capital, whereas firms operating at small scale require less working capital. Next point is nature of production technology. In case of labor intensive technology, the unit will need more amount to pay the wages and therefore will require more working capital. On the other hand, if the production technology is capital intensive, the enterprise will have to make less payment for expenses like wages. As a result, enterprise will require less working capital. Next point is length of production cycle. In manufacturing business, the requirement of working capital increases in direct proportion of length of manufacturing process. Longer the process period of manufacture, larger is the amount of working capital required. Next is seasonal variation. In certain industries, raw material is not available throughout the year. They have to buy raw materials in bulk during the season to ensure an uninterrupted flow and process them during the entire year. The seasonal enterprises, that is, the enterprise whose operations pick up seasonally, may require more working capital to meet their increased operations during the particular season. A popular example of seasonal enterprise may be a sugar factory whose operations are highly seasonal. Next is operation efficiency. Operating efficiency entails how fast you can convert raw materials to finished goods, sell these finished products, and claim your payments from customers. High efficiency businesses require less working capital. However, in the case of lower operating efficiency, your company will require more working capital. Next point is credit policy. The credit policy of a concern in its dealing with debtors and creditors also influence considerably the requirement of working capital. A concern that purchases its requirement on credit and sell its product services on cash require less amount of working capital and vice versa. Next point is business cycle. Business cycle refers to alternate expansion and contraction in general business activity. In a period of boom, that is when the business is prosperous, there is a need of larger amount of working capital due to increase in sales, rise in prices. And next point that or factor influencing on the requirement of working capital is rate of growth of business. The working capital requirement of a concern increase with the growth and expansion of its business activities. Although it is difficult to determine the relationship between the growth in the volume of business and the growth in the working capital requirement of a business. Yet, it may be concluded that of a normal rate of expansion in the volume of business, we may have retained profits to provide for more working capital. But in fast growth in concern, we shall require a larger amount of working capital. So, student, here I'm ending my session with the point factors affecting on working capital requirement. In next lecture, we will continue with the working capital management and other important aspects concerned with the same. Thank you.